Good morning, ladies and gentlemen. Welcome to today's virtual non-deal roadshow. My name is Nadine Salonga, virtual event moderator here at Renmark Financial Communications. On behalf of our team, we want to thank everyone in San Francisco and surrounding areas for joining us today for the presentation of Silver Crown Royalties, trading on the CBOE under the ticker symbol SCRI, and on the OTCQX under the ticker symbol SLCRF. Presenting today is Peter Burris, founder, chairman, and chief executive officer. With that being said, I will now hand over the floor to Peter.
Thank you, everybody, for joining us today online. My name is Peter, and I am the CEO of Silver Crown Royalties. There's not too much about me in the presentation, so I'm going to tell you a little bit about myself, and then obviously you can ask questions at the end. But I'm a mining engineer by background. I spent quite a bit of time in research, various capacities, covering precious metals, base metals, and steel stocks. I spent some time on the buy side as well, where I worked with one of the best portfolio managers, Kevin McLean, worked at Century Investments for a number of years. I spent some time in New York as well, working on the BMO institutional sales desk as a mining specialist sales. And then about 10 years ago, I covered royalty companies, and that's where I really got more of an in-depth understanding of this type of business. And about 7 years ago, I started launching companies, building companies, taking them public, and Silver Crown Royalties is one of these projects that's successfully went public July last year. We've been public now just for over a year, and we've grown the company, I think, relatively successfully, and we continue to do that. So that's my background, that's my involvement with the company. Forward-looking statements, obviously, some of the things that I talk about here may or may not happen, circumstances beyond anybody's control, etc. So why did we focus on silver? So Silver Crown Royalties is a 100% silver-focused company. We don't do any other metals. We have no revenues from any other metals, only from silver. So why did we choose silver? Really, long story short, it has all the qualities of gold, except nobody is in the space competitively looking to do silver-only projects. There's a lot of them out there that are available, and the lack of competition right now is what kind of opened the door for us to focus in on that space while maintaining all the monetary, as well as to some extent industrial properties of precious metals like gold. For us, the main specific focus was that it maintains purchasing power through time. How does it do that, or what is purchasing power, or how does it change during time? So what we found is a statistical relationship between the nucleus of credit expansion, which is what ultimately leads to devaluation of a currency, and that nucleus is US dollar debt. So at the very beginning of all inflation is the expansion of the credit system itself, and at the core of that is US dollar Federal Reserve level debt. So as that debt grows, and at a rate at which it grows, the number of dollars in circulation increases, and the more dollars there are relative to a fixed number of goods and services, a fixed number of ounces of silver, a fixed number of ounces of gold, that is a reflection of the lower purchasing power. So if you have $1 in 1 ounce, then you have $1 per ounce. If you have $30 in 1 ounce, it's $30 per ounce. So as the credit mechanism expands, there's more and more dollars in the market. The more dollars there are, the less they're worth. Their purchasing power goes down, and the price of silver, gold, and other commodities, other real assets, goes up. The rate of credit expansion should therefore guide us in terms of how quickly the US dollar is being devalued. And we think that we've statistically shown that. I know this chart may be a little bit confusing, but essentially what we're showing here is that if the credit market expands at X, and yes, it is referred to as credit bubble in some circles, as it expands at X, then the rate of change of the currency devaluation is some multiple of X. The faster it expands, the faster the purchasing power declines. The slower it expands, the slower the currency devaluation declines. But as long as it's expanding, purchasing power goes down. What this chart shows is entry and exit points based on whether or not the metal price has gotten ahead of the devaluation of the currency, or if it's lagging behind. the devaluation of the currency. What we saw at the beginning of November was a little bit of silver gold prices getting ahead of themselves relative to where they theoretically should be based on the credit expansion. We've seen a little bit of a correction, and now we're back sort of very close to where the entry point would be again, that is low risk level. Bottom line though is it always makes sense to be long precious metals only if they're going to be used as a hedge against currency devaluation. So that's one of the key attributes that attracted us to silver, hedge against currency devaluation. And not very many companies out there are pursuing only silver. They're looking at gold, they're looking at other metals that have monetary properties, but none of them are focused solely on silver. So that allows us to enter that market and be able to deploy capital effectively. So we've built this company because, again, there were no other silver royalty companies. We have obviously the same attributes as other royalty companies. Our approach is a little different in that we're very conscious of risk. So we want to diversify our portfolio as much as possible and not have any one given major asset that is responsible for the entire net worth of the company. So we want small little assets and build the company around that, just in case anything happens to any one of them. We believe that our investors' capital would be protected. Obviously, we're also focused on return on invested capital above the weighted average cost of capital. We have structural and organic growth, unlike the metal itself. So if we do like silver, why don't we just buy silver stored in a vault? Well, there's no organic growth, there's no structural growth. What do I mean by organic growth? It means that single ounce of silver is not all of a sudden going to become two. By structural growth, I mean nobody's going to bring in another silver ounce at below market. So there are certain factors inside of a company which allow for these features to exist. And this is what we focus on, and this is what makes the company a little bit different. And I'll go through another checklist in just a minute. But royalty companies, this is why we like the business model. Here's a case history. This is Wheaton Precious Metals. When they started 20 years ago, when they went public, that was an 80-fold increase ago, maybe even more. This chart is a little old, doesn't capture the full appreciation of Wheaton Precious for the year. But what we really wanted to demonstrate here is that Silver Wheaton has, or Wheaton Precious Metals as it's now known, has outperformed the metal price itself by a factor of 15 over that time frame. So you were much better off owning a royalty company than the metal itself. And at the bottom, and I'm not specifically picking on Newmont, even though that's what that is, but producers generally over the cycle don't really have the ability to consistently return capital or generate returns on invested capital or deploy capital at advantageous returns through the cycle. And that's why in this case, you can see that Newmont underperformed just a buy and hold strategy for gold. So buy and hold works for royalty companies, not so much for producers, not so much for developers. And there's a lot more work involved. You have to be very knowledgeable. You have to have a very high appreciation of things like geology, metallurgy, political risk, all kinds of things. And that's what a royalty company essentially removes from that investment thesis by diversifying across the base. And that's what we focus on. Another case study is Franco-Nevada. Now, this is Franco 40 years ago, not the one that we know today. This is the one that started in the early 1980s and ultimately got acquired in 2002. And what we can see here is that a very aggressive, very rapid revenue growth rate, which coincidentally is what we have been tracking so far. And we should be able to achieve the same growth, the same revenue that, again, coincidentally, Franco had in the mid to late 80s, about $3.5 million Canadian. At current metal prices, in fact, it could be closer to $4 million for us. Nonetheless, what I wanted to show with this chart is that we are at a stage which is essentially ground level entry. We are very early in the life cycle of a company, as it were. We're definitely not mature. This is a very early entry point, and that's what we wanted to show with this chart here. We've seen recently some comments around Warren Buffett no longer writing his commentary on the market and his worldviews, etc. But we wanted to include this chart here as the decision-making process for an investor to make in a company. Warren Buffett had a certain checklist. Company has to be so simple to understand. Well, we're just silver and we're basically exchanging paper money for silver ounces. Consistent operating history. I did mention we're quite young, but we do have 3 years of revenues. Economic moat. Again, nobody's really focused on silver as a primary source of their revenues, maybe secondary, maybe tertiary, but certainly, we can argue that there's a little bit of an economic moat that we have. And there's one aspect of our royalty structures that I will talk about in a minute that allow us to essentially create our own moat. Rational management, alignment. There is alignment between management's ownership, my ownership of the company. In fact, I added to my position today being off restriction again. And I continue to add. There's a chart in the presentation that I have that shows exactly that. My ultimate benefit from Silver Crown Royalties will be exactly the same as any other shareholders through dividends and through share price appreciation. Free cash flow, we're not there yet. However, we believe, fully funded to free cash flow, and we should be in a position to generate free cash flow in the second quarter of next year. Margin of safety is another thing Warren Buffett talked about. Valuation, I talked about that in a little bit. And long-term horizon. In order to get to 0.5% of the silver market, it would take us close to 10 years. So I believe that as a safe investment in a very cyclical and very rocky commodity price environment, I think that we've created a company that is safe enough to invest in, even by Warren Buffett's standards. And as we all know, he was not very much enthralled with precious metals, mostly because in his mind, well, the metal just sits there, doesn't pay a dividend, and that's true. And that's why we're creating a company here that ultimately wants to pay dividends out of free cash flow, wants to be a yield product, which obviously would tick that dividend box. In terms of what we do, quite simple, kind of alluded to it, we take paper money up front and we buy silver in the ground or coming out of an operation at a discount to market, and then the silver comes back to us as long as that operation is producing. I talked about that moat, that safety, isolating our business model a little bit from competition. So one of the things that we've done is not only do we focus on a single mineral, whereas other royalty companies by their very nature don't, we also look at royalties as business units. We expect our capital to come back to us, so we write the contracts that essentially obligate the producer to deliver some number of ounces to us over a certain time frame. So it's not just a percentage, it's also a minimum delivery structure. And what this allows us to do is to uncover value for unreported silver that would come out of non-traditional operations. So everyone understands and sees, as it's reported, silver comes out of mines, and that's great. But silver also comes out of refineries, smelters, many other infrastructure type projects, but that's not reported. A lot of smelters are either private, or the production of the metals is so minuscule compared to the other metals that come out of the operation, they're simply not included in any kind of reports. Geologically, metallurgically, we know the silver is there, it does get recovered. And again, how we can approach that is by having those minimum deliveries and having a plant, for instance, or somebody that's reprocessing stockpiles. We can have those producers, those operators then commit to minimum levels of deliveries to us other than just a percentage, giving us a little bit of that margin of safety as well. Further, we also incentivize companies to do better, find more ore, find more ounces, increase production if it's a production plant, etc. We pay out essentially bonuses for increased minimum deliveries or additional discovered ounces. And this is on a case-by-case basis. There's no real cookie-cutter approach here, but there's a general mechanism that we apply for each one of the royalties that we create. And that's another key point. Most royalty companies, especially ones that are small, under $1 billion market cap, do not create new royalties. That's a very rare thing for small royalties. They're more royalty aggregators in that they trade royalties that already exist, or they take royalty portfolios from producers and buy them or take them public or in some other way unlock value for those royalties that are in someone else's hands. What we do is we create our own royalties in every instance, because there were no silver royalties or pure silver royalties. There were streams, but not royalties when we started this company. So we had to create all of our royalties. We continued to do that. And that allows us not only to put in these novel structures, but also we know what's inside the paperwork in every instance. So yet another, kind of ability to protect our investors' capital as far as we're concerned. And it also allows us to target internal rate of return targets or internal rate of return numbers that are in excess of 25%. And on average, so far, based on trailing 12-month prices at the time of the transaction, we've been able to accomplish that. Again, this is because we're creating our own royalties. So if we can't get this IRR target, we simply don't do the deal. And we have walked away from deals before because, well, the operator or producer was simply asking for too much, and the return would have been below our cost of capital. So we simply said, this doesn't make sense for our investors. We're going to move along. I mentioned 0.5% of the market. Well, what's the market? There's 2,400 operating mines out there that have silver in them. There's over 30,000 exploration level projects that have silver in them. There's countless number of recycling facilities, reprocess plants, the infrastructure that I spoke about. Our pipeline at any given point has 10 various projects in it. They could be, again, recyclers, they could be mines, they could be a plant that's about to be built, things of this nature. Generally right now, these are in tier 1, tier 2 jurisdictions. We're focusing on North and South America and Australia as well. Not so much on Africa, not at this point, not yet. We want to get to free cash flow positive, and we want to be able to pay a dividend before we start getting into more esoteric areas. We've averaged 2 royalties per year, which kind of brings me to a point that, we think that we are getting closer every day to having another deal. As I said, we work on 10 of them at any given point in time. Some of them fall away, some of them don't pass due diligence. In some instances, again, the IR is just not good enough for our investors, so we drop it or we put it on hold or what have you. The development of the market capitalization of the company relative to the silver price, I think everything is now baked into the share price now. With our latest financing, we are now fully funded to free cash flow. So I think that that's why this stock is now re-rating a little bit. It's on sale actually today, about 7% off, which is great. Somebody got off their position. That's investors do various things for various reasons. It's tax loss selling season now across North America, so maybe that was a part of it. We're not exactly sure. However, we do know that we do get, as the B leg shows here, we do get rewarded for doing additional transactions and for reporting sequentially positive quarters. When we put out Q3 last week, we believe that's our low watermark quarter, not just for this year, but probably for the history of the company. Q4 is shaping up to be a lot better than Q3 already. Q1 should be an extension of that, and then Q2, one of our more important royalties, kicks into high gear, and we should be able to get to that free cash flow at that point. So I think that's what the revaluation is doing here. Now, historically, we've traded around 12 to 20 times sales. We're around 14 times sales right now. So I think the stock isn't expensive. I've been buying it in the market. We do have other supporters that are, insiders that accumulate when the price is attractive, which they think it is right now. So I've purchased more than 20,000 shares since we IPO'd last year, and I continue to do so. I'm off restriction again today, so I was picking some up again this morning. This is where we trade relative to other companies, royalty companies that are in the sub-billion market cap category, and this is on a price to sales basis. There's a good reason why a price to sales is not an illogical multiple, and in this case, it's because price to sales for a high margin company like a royalty company, where 95% of revenues end up in free cash flow, well, price to sales essentially mimics free cash flow if a company has free cash flow. Most everyone that's in billion market cap or less doesn't have free cash flow. We're guilty of that as well. So that's why we're looking at price to sales. Price to sales Comps are about 40, 45 times. I know that's a little extreme. Like I said, we're about 14, 15 times, but certainly 20, 25 would be justifiable. So that could, generate not an inconsequential return for anyone that's looking at the stock today. And $48, that was the stock price when we did this presentation a couple of weeks ago. We're over $50 now. The difference would be minute, but we think that the stock could be trading between $13, $21 when we hit free cash flow next year, or on revaluation when we announce another transaction of a cash generating asset, which again, we're working on very diligently, and we're trying to get that announced whenever it makes sense to do so. When it's legally binding and it's funded and it's ready to go, we'll be able to do so. This is our production profile, as it were. So these are the silver ounces that we are to receive based on those minimum delivery contracts that I spoke about. So you can see that next year we should be somewhere between 43 and 62,000 ounces, and that gets us to that price to sales multiple that would justify these share prices. So one of two things in my mind re-rates the stock. One, we wait until we print Q2 next year showing free cash flow, or we announce a transaction sometime between now and then, and that ultimately should re-rate the stock as well. In terms of capital structure, we have 3.8 million shares outstanding, 6 million fully diluted. On dilution, that would include 8.25 warrants, which are trading listed, $16 warrants, which are trading listed, would bring about $26 million of additional capital, which is actually more than what the market cap of the company is right now. We're at 21 million market cap. I know it says 22.5, but again, that's from 2 weeks ago. This shows you all the equity issuances that ever took place. The 1, 4, and 8 rounds, these were private. The $10 was IPO round. Then there was a 650 unit and the 550 unit, which we just completed at the start of October. And that's what got us to the position now that we don't have to issue any more capital until we're free cash flow positive. And this is the first time that we can say that in a presentation since October 3rd. Now we can say it. We couldn't before October 3rd. We now have the cash to get to free cash flow positive. We do not have to issue capital at prices where we don't think it makes sense. So we won't. We want our cost of capital to be low. That's why we went public. We don't want to dilute our shareholders unnecessarily at low share prices. And like I said, there's a number of catalysts, in our opinion, that we think will re-rate the stock higher. And then if we wish to do something at that point, great. But I certainly personally, I would not wish to issue equity under $10 ever again. Ownership by investor types, 49% retail, 14% institutions. We have Euro-Pacific Asset Management, has about 7% of the company. They were big supporters on the IPO. They bought additionally in the market. US Global, they've participated on a number of financings. Management is 20% of the company. I myself am around 8%, give or take. And again, I continue to accumulate as opportunity arises. That's mostly dependent on whether or not we're restricted, and will be restricted when we have information that could be deemed material and has not been fully disseminated. From that point, I can't purchase any more equity. And that's it. I can go in depth into how we structure things, how we look at things, but I'd like to open the floor up now because we try to really keep this company as simple as possible, an investable silver product with ultimately yield where you're exchanging fiat paper money for an inflation hedge protected product.
Thank you, Peter, for the presentation. So we'll now move on to the question and answer session. Your first question is, and it's a bit of a long one, so bear with me. With a higher price of silver, I imagine acquiring new silver royalties is riskier and more expensive. How is Silver Crown mitigating the downside risk of silver when evaluating new opportunities? And are you open to pursuing joint or syndicated royalty structures to manage the upfront capital costs and improve risk-adjusted returns?
Two sides to this. I'll start with the latter part. Yes, we're definitely open, and we would like to ultimately end up syndicating a royalty based on commodity lines. So we would do part on the silver, someone else does part on the gold or the copper or other metals that may be in the deposit. On the front part, because we create our own royalties, we're not competing for anything that's out there. So yes, you're right, metal prices go up. if there's royalties out there that exist, there's more competition for them. And of course, the seller thinks they can get a lot more for them, and ultimately they likely can. The way that we approach that is we sit down with the operator, and a lot of these deals take quite a long time to put together. EDM, which we just closed a couple of weeks ago, took over 2 years from concept through negotiation, etc. When we originally looked at that transaction, silver was at $18, $20. Right now, when we closed the deal, silver was over 40. We didn't really adjust the terms over that time frame. However, looking at new deals today, what we do is we look at the 12-month trailing price of silver, and that's what serves as an input. We look for 25, 30% IRRs, and that's the initial point to start structuring the royalty. These royalties, because we focus on silver, that's a very minute portion of the economics of a project, usually 1% or less. The difference is between 25% IRR, 20% IRR, 30% IRR, or $35 silver, $40 silver, $45 silver are so minute to the operator that it essentially it becomes a rounding error. The other part where we try to sweeten the deal, as it were, is we utilize our own equity. So bonuses would be paid out in equity of Silver Crown, and certain portions, even of the initial transaction, would be paid in Silver Crown equity. So as the deal is better for us, that means that the share price has more to appreciate, which means that ultimately the shareholder, the operator, has more capacity to get a re-rate in Silver Crown royalties, and what they do with the stock in 2-3 years after they've made their return multiple fold, that's up to them.
Your website indicates 3 types of royalty structures, type A, B, and C. Is there anything investors should be aware of concerning the differences?
Yeah, the key difference is that the B type, that's royalties where the silver is not reported. And that's a very important part of our business. There's a slide in the presentation I didn't really talk to very much, but we estimate that half of the silver that's produced from mines or from various types of infrastructure like recycling facilities or refineries is not reported to the public. It's of course reported between all the various infrastructure projects that touch the silver from the mine, creating the concentrate, going to the smelter, creating some, doré product that then goes to a refinery. So at every point in time, everybody knows that there is silver, how much of it there is. It's just not reported to the public because it was never in the reserves, and now it would cost too much to include it in reserves, et cetera, et cetera. So we focus on that, and that's the B type. This is where we help companies uncover value for silver that the market otherwise would not give them. So if you're a gold producer and you have 1% of your revenues coming from silver, well, that silver could be worth 15 to 20 times sales, as I mentioned on the price to sales chart inside of a royalty company, but the gold company maybe trades at 1 to 1.5 times sales. So for the producer, there's a valuation arbitrage motivation to unlock the value of that silver, and that's the B type approach. A type, relatively simple. The silver's there, it's reported, it's in the reserves resources. That's the minimum delivery part. That's the kind of novel part of that. And the very last one is simply including not just exploration bonus, it's a combination of A and B, but also it's the focus on the infrastructure and utilizing more of our equity for various types of deal structures.
Does Centurion One Capital provide any research coverage?
That's a great question. I actually have a call with Kaya today, and I will find out. We do have coverage, however, from Colowar Capital, which is a Vancouver, BC-based shop. They do cover other companies. I actually quite enjoy their research. It's about as independent as you can get for paid for research. The only unfortunate part is that it doesn't get on IBIS and various other types of data aggregators like Bloomberg and what have you, so it doesn't end up in the comps. But I think they've done quite a good job with our company, and I'm perfectly happy. I used to cover royalty companies as well, so I'd be perfectly happy to go over that research with whoever's asking about the question and go through how the market looks at royalty companies and the various metrics that are in focus and the ones that don't matter.
With silver near all-time highs right now, what's to say a rapid downturn isn't on the horizon?
You know what? That's absolutely possible. We don't share that view simply because you would really have to clean up the US's balance sheet, and you would have to remove an awful lot of leverage from a US dollar denominated market, which still by all counts is more than 70% of all the paper that exists on Earth. So, that would have to, but nothing is impossible. So our approach is, because we have that 25-30% IRR target, and because our cost of capital is somewhere around 13%-ish, and I can go in depth as to why I believe that is, because we use a backward-looking 12-month or 52-week low or whatever conservative silver price through the entirety of the cycle, we'll capture the average price and generate 25-30% return on that. So if silver prices were to go to $25, $20, we would structure transactions where instead of paying right now, we're sort of $10 to $15 per ounce produced coming back to us, maybe we would pay $5, $8. Conversely, if silver goes to $100, we'll be paying $35. But over the average cycle, let's call it 20 years, silver goes from 10 to 100 back to 10, you're averaging around 50. That's what the entirety of the company would end up having that 25-30% return on. And in part, you can see in that chart that I showed with wheat and precious metals divided by the price of silver, you can see that through the cycle, they were able to accrue capital to their balance sheet because their investments were above what their cost of capital was. And the silver price itself, ultimately, even though it did go up over that time frame, you can see that wheaten relative to silver is pretty steady. There's very little volatility to it. So ultimately, that's what I believe happens with this approach.
Which of your royalties has the strongest potential to outperform expectations in 2026?
That's a great question, because I think there's two that can do that. One of them being PPX, which is our best royalty right now. They're our best partner in terms of counterparty risk, counterparty credit risk, etc. They're fully funded for the expansion. In fact, they believe that they can get everything done by the end of this year, start commissioning Q1 next year. So the surprise there could be first quarter next year could be better than what we're anticipating, which is more or less steady state from what we've seen so far this year. So that could be a nice positive surprise. And of course, we do expect them to be hitting the commitment in Q2. And again, that's a big driver for us there. In terms of the second one that could be the biggest surprise really is Pilar, which I think quite a few people have written off. They recently announced some management changes. There likely is capital that's been secured. We have seen videos from the operation of trucks moving, mills starting to turn. There are certain permits that still need to be had. There are certain other boxes to tick, but that project could very well restart by the end of this year, maybe Q1 next year, and that could be on a trajectory to, I'm not going to say massively surpass the 16,000 ounces that we're expecting, but it could certainly hit more than 20. And again, that's that would be an upside surprise. But frankly, I think there's upside surprises that could come out of our other royalties as well. But these two would have arguably the most impact.
While still early for the company, do you prefer variable or fixed style dividends?
I would prefer to. Ultimately, the dividends are going to be variable, and that's just the nature of the silver market. Somebody asked a question: what happens if silver goes to $20? Well, at $20, we should break even next year, but free cash flow would be very close to zero. So the dividend would be very close to zero. On the flip side, silver goes to 100. Well, the dividend would be quite substantial, and especially on a yield basis, would be quite substantial. Because ultimately, we're not looking at this as a capital appreciation. We hit the next drill hole, or we're going to get revalued, and that's it. Exit the stock. We're looking at this as a yield product. Again, through the cycle, that yield should end up being relatively consistent. And also, as we continue to bolt on more royalties, that dividend should grow naturally anyway. So over time, I think that the trajectory of the dividend should be up, despite it being ultimately variable. And again, this is a board level decision that we're going to make when we are free cash flow positive sometime next year, in terms of how we want to structure that. Personally, I would like to see 90% free cash flow paid out in dividends. Why? Well, because that's how I get paid. And again, I spoke about alignment between management and other investors. We get paid the same way you guys do, through dividends. So my salary is capped. The more dividends I make, the lower my salary is, the higher the free cash flow, so I can pay more dividends. But ultimately, I want to make $1 in salary and all of my income in dividends. There's tax advantages, but there's also motivational factors, right? The more dividends there are, the more growth there is, the better off, well, I am, but the better off investors are as well.
Why not provide details in the Q3 release on where deliveries are coming from?
There actually are details to that in the MD&A. I don't know what page they're on, but the CFO does provide a detailed breakdown of which project the ounces come from. So that's there's a table there, and it shows, you know, line by line where, and it goes all the way back to our first transaction in 2023. So you can track exactly where the ounces do come from, where they don't come from, where the delta is between the quarters, and ultimately why, you know, I just shared now that it's not in the quarterly update or whatever, but why I believe that Q3 is the low watermark for deliveries. And part of that has to do with PPX's performance in the second half of the year so far.
Are you looking to build the business for multi-decade success, or would you rather position it for M&A activity given current market conditions?
I would like to build this to be multi-decade success. Again, this is, you know, I will get paid from dividends. That's going to be what makes me successful. So that's what I would like to see, this as a generational product that can go into everybody's retirement portfolio. But having said that, look, you know, we have to be pragmatic about everything. And if there is any kind of M&A activity, you know, somebody decides to pay a massive premium for where we are, well, that's going to go to the board, and the shareholders are going to make that decision. We are quite concentrated in terms of shareholder ownership. There's, between 6 or 7 shareholders. We can get over 50% of the vote if that's required, or close to 60, or whatever the numbers would be. But certainly that, you know, ultimately it's the shareholders' decision. Personally, yeah, would I welcome a takeout at $20 a share today? Absolutely, I would. But I believe that we can ultimately get to $50, $100 a share just by growing the company along the same path that we've been growing it.
Are there any buybacks on any of the royalties in the portfolio?
The answer is yes. I believe that 3 of them have buy downs, not buybacks, buy downs. And generally, the way that works is all the money that we would have put in, including the value of the shares that we would have contributed to that operator, they have to return all of that, and the royalty is cut in half. So let's say it's 90% of the silver, and we put in $3 million. For $3 million, they can take that down to 45. So from an IR perspective, that ends up being relatively in line with that 25 to 30% return target.
What is your expected timeline to reaching positive operating cash flow?
Conservatively, Q2 next year, so that will be reported in the third quarter of next year is when we would report Q2. Aggressively, it could be as early as this quarter, Q4. The likelihood of that, I'll give it less than 50-50 for Q4. That's why I said as aggressive. But conservative for next year, I think the likelihood is relatively high, again, because of the success that we've seen at PPX, which solely on that operation, we could have positive free cash flow in the second quarter of next year and pay a dividend from that. On an annualized basis, at current metal prices, that would be somewhere between $2 and $3 million in free cash flow on an annualized basis. So for a 21 million market cap company, 14% free cash flow yield, that's not bad, especially considering that on a free cash flow yield basis, comps trade in the sub 5%, but closer to 3% range.
Would you say that silver royalties and companies are disregarded?
Well, we're the only silver royalty company there is, and perhaps we are, not on everybody's radar. Look, we're small, right? We're 20 million, 22 million market cap right now. It's not for everybody's portfolio, not yet. To get on more radars, you need to get bigger. And so we need to keep growing, and that's what we're doing. Or you need to get to a point where you're returning capital so you can no longer be ignored. We're not going to do a buyback that doesn't make any sense, but the dividends that make a lot of sense. And again, in part, maybe that's selfish because Some obviously as a shareholder, that's going to come to me too. But ultimately, I think that the stock will not be ignored. But you can look at other royalty companies as well that are sub 100 million, and especially if you're sub 50 million, it's not easy getting on people's radar. Now, having said that, those sub 50 million market cap companies still trade at 30, 40 times sales, and we don't. So relative to the guys that are in the same boat, we're definitely overlooked. Now, we're the only silver royalty company there is. All the other guys are polymetallic, usually gold. I mean, Franco's an exception. They have a 15, 20% oil mandate as well. But most of the other royalty companies are gold. I don't think that, it's precious metal space. So I don't think that there's any discrimination necessarily against silver per se.
Do you see enough runway for new deals in the Americas?
Yeah, absolutely. We're working on a handful now. They wouldn't be, massive, but they would be, because we are still so small, if we're doing 42, 60 odd thousand ounces next year, if you bolt on 30, 40,000 ounces, that's a transformational deal. And, we can bolt that on with what we have on the balance sheet, again, because we strive to utilize our equity as much as we can. And, I said we're not going to issue equity under a certain price, or certainly I wouldn't like to, but we've done transactions before. We were trading at $7 and we did a deal at $10, whereby we issued $1 million worth of equity deemed to be $10 a share. So 100,000 shares, we were trading at $7. So there's really nothing that's stopping us right now from saying, okay, listen, let's do a deal. But we both agree that the market price of Silver Crown doesn't reflect ultimately what it's worth. So let's do a deal at $8 or $9 or $10. And because it's a private transaction between two willing parties, you can price the stock at whatever you like. And it certainly beats issuing equity at $5.50.
Will you be updating the market on project milestones?
Oh, absolutely. Yeah. Based on what is publicly disclosed, obviously we can't front run our partners. So we do end up being in possession at times of information for the various projects that they have not yet released. But whenever they come out with an update, whatever, we will piggyback on that, and we'll definitely get it out there to our investors so that they're kept up to speed.
Thank you so much, Peter. So that wraps up your question and answer session for today. If you did not get a chance to submit your question, you can reach out to the appropriate account manager here at Renmark. That concludes our presentation for today. But before we go, I will turn it back to Peter for final remarks.
If you guys have any more questions and want to reach out directly, silvercrownroyalties.com is the best way. Emails there, phone numbers there, so don't hesitate to reach out. We're also obviously on X and on LinkedIn, so we'll answer questions. DM me. Thank you.
Once again, this was Silver Crown Royalties trading on the CBOE under the ticker symbol SCRI and on the OTCQX under the ticker symbol SLCRF. Thank you again to everyone in San Francisco and surrounding areas for joining us today. Stay tuned for other presentations in your area, and see you next time.